Welcome to Intelligent Investor Insights with Joshua Barone, your host and guide through the noise of today's markets. Here we interpret the data behind the headlines, break down what's driving the economy and interest rates, and help serious investors make decisions rooted in clarity, not emotion. If you're looking for disciplined, research-driven insight to strengthen your portfolio, you're in the right place.
So imagine you are driving a semi-truck down a winding mountain pass, but there is a catch. The windshield is painted completely black, and the only way you can steer is by looking at the rear view mirror. Sounds like a disaster, right? But that is literally how we have been tracking the US economy for a century. Think about it. A CPI print arrives 6 weeks after the prices it describes are actually paid by people at the register. By the time the Bureau of Labor Statistics releases their monthly payroll report, they are showing us a photograph of a month that has already passed, already dead and gone. We are always reacting to yesterday's news. But over the last year or so, something really fascinating has happened. These online prediction platforms, specifically Kalshi and Polymarket, which were basically built for people to bet on elections or pop culture, they accidentally created a live, continuously priced macroeconomic dashboard. Right now, Polymarket alone has over 157 active economic markets. We are talking 28 different markets tracking the Federal Reserve's next moves and 19 purely on inflation. Now, look, when these things first popped up, my inner value investor, my dad's econ training, it all screamed, stay away. I saw prediction markets and immediately thought, okay, this is just a digital casino for kids who have too much crypto. But then I looked at the plumbing. These contracts are not just settled on a whim. They settle directly against the BEA's official GDP releases and the BLS's CPI printers. The moment I realized the payouts are hard-coded to the actual government data feeds, my skepticism shifted. It is not just betting anymore. It is a real-time consensus engine, pricing macro risk seconds after it happens, not weeks. But the plumbing between these two giants, Kalshi and Polymarket, it is totally different. And that difference matters a lot if you are trying to use them as a serious tool. Kalshi is fully regulated by the CFTC. They settle centrally, directly against named government feeds. No exceptions, no dispute mechanism. It is clean, it is binary. Polymarket, on the other hand, operates in this decentralized global space. They resolve their contracts using a decentralized, crowdsourced oracle called UMA, where any trader can formally dispute an outcome if they think the data is flawed. And this structural split completely changes who shows up to play. If you are a big institutional trading desk, you need the regulatory certainty of Kalshi's central clearing model. You cannot explain a decentralized oracle dispute to your compliance officer while standing on one foot. But if you want massive global liquidity pools, you go to Polymarket. And boy, that liquidity is chasing some wild things right now. By mid-2026, tariff and trade policy contracts became the single largest macro category on Polymarket. Think about the power of that. Instead of waiting for a shipping company's quarterly earnings call, you have traders pricing the probability of a border tax in real time, factoring in supply chain disruptions months before those container ships even reach the ports. It is a completely new way of looking at economic risk, but it also opens up some massive vulnerabilities. Now, before you dismiss this as just a playground for retail speculators, you have to look at what the central bankers themselves are saying. In February 2026, researchers at the Federal Reserve Board, Anthony Dirks, Jared Katz, and Jonathan Wright, published a paper called Kalshi and the Rise of Macro Markets, and their conclusion was downright shocking. They found that these prediction markets actually perform on par with the Fed's own primary dealer survey, even 3 meetings out. Let that sink in. A bunch of anonymous traders online are matching the collective wisdom of Wall Street's most elite economists. And it gets even crazier. The paper showed that on the eve of FOMC meetings since 2022, prediction markets correctly identified the target rate outcome with a statistically significant improvement over traditional Fed funds futures. Why? Because traditional derivatives have all sorts of institutional constraints and liquidity friction. Prediction markets are pure, unadulterated sentiment. Plus, they are currently filling a massive derivatives vacuum. Historically, we have never had liquid financial instruments to hedge or forecast core inflation, GDP growth, unemployment, or non-farm payrolls. These markets are filling that empty space, giving us a dial for things that used to be completely unhedgeable. But we have to be careful here because there is a massive trap built into the design of these contracts. Duncan Hennis, a managing director over at KPMG, put out a really sharp warning about this. In conventional finance, models assume prices fluctuate continuously. Stock prices go up and down by cents and dollars. But event contracts are strictly binary. It is a discrete 0 or 100 outcome. Either the Fed cuts rates or they do not. That completely warps your margin dynamics and your options math. If you are a mid-sized asset manager thinking you can just easily trade these in size, you need to watch out for the liquidity mirage. The headline volume numbers you see on Twitter, they look huge, but the actual order books can be dangerously thin. You have wide bid-ask spreads, and you are constantly competing against highly sophisticated algorithmic bots. That said, the smart money is absolutely watching. Firms like KeyRock are actively parsing the inflation in 2025 markets to capture real-time sentiment shifts weeks before Bloomberg can even publish its consensus survey of economists. It is an information race, but you have to know how to read the track. And if you think macroeconomics is just about interest rates and CPI, you are missing the basement of the whole building, which is weather. A September 2025 study from the Bank for International Settlements showed that severe droughts cause an average 2% drop in GDP, and landslides knock off 1%. Weather is a massive leading economic indicator. Look at what happened in July 2026. JP Morgan warned that a super El Nino-driven oil shock could add 0.3 percentage points to global inflation, and food prices typically run 0.5% higher a full year after a major climate event. So naturally, traders are trying to front-run this. You have people like Marvin Gabler at JWA trading Polymarket temperature contracts against proprietary climate forecasting models. But as a value purist, this is where I start pulling the emergency brake. Weather prediction contracts simply do not have the same rigorous, multi-year validation history that CPI or Fed contracts do. It is a highly speculative, highly volatile corner of the market, and if you are not careful, you can get absolutely wiped out by localized anomalies. To show you exactly how fragile this can be, you have to look at what happened in Paris back in April 2026. It is a story I still chuckle about, but it is a serious warning. A Polymarket trader using the handle XX25XX placed a $119 bet that the temperature at Paris's Charles de Gaulle Airport would top 64 degrees Fahrenheit on April 15th. Simple enough, right? Well, on that exact day, the airport sensor recorded a sudden, completely unexplained spike to 22 degrees Celsius, which is about 71.6 Fahrenheit, before immediately dropping back down to normal. That single spike triggered the contract, netting the trader $21,398. Meteo France actually filed a police complaint, and the leading theory online is that someone literally walked up to the physical sensor at the airport with a hairdryer or a lighter to game the system. I mean, it is brilliant in a devious sort of way, but it exposes a massive systemic lesson. Physical single sensor settlement has a localized vulnerability. You cannot hold a hairdryer up to the CPI. The CPI is compiled by nationwide agencies under intense public scrutiny across thousands of data points. Weather contracts settled on a single station are inherently fragile, and we cannot forget that. At the end of the day, as an advisor, my job is to help people build portfolios engineered to last generations. And my playbook on this is simple. You have to separate the tested dials from the unproven ones. The Fed rate contracts, the inflation markets, those are backed by real academic validity and deep liquidity. Use them as a fascinating real-time complement to your traditional research. But please, do not let a binary betting market replace a disciplined, cash flow-driven, fundamental underwriting process. You cannot run a family office on a series of coin flips. But I do wonder sometimes, as these markets grow and get more accurate, if we are heading toward a world where the Federal Reserve itself is going to have to start referencing prediction markets in their official policy statements. It is a wild thought, but we might be closer than we think. Anyway, that is my take on it. I am going to get back to the spreadsheets. Talk soon.
Thanks for joining Joshua on Intelligent Investor Insights. If today's discussion raised questions about your portfolio strategy, risk exposure, or how to navigate this late-cycle environment, we invite you to connect with us. We work directly with investors who want data-driven guidance, institutional-level analysis, and a partner in building durable wealth. Reach out to start the conversation and take the next step toward becoming a more informed, confident, and resilient investor. Until next time, stay rational, stay disciplined, and invest with intelligence.